Hello investors, you want to know if a stock is expensive? Well, maybe you can check the cashback PE at EPSMomentum. It's a different way to see the PE ratio, much more accurate, so listen in. So you're looking at PE ratio and you really want to know if a company is expensive or not. And the traditional way of doing this is just to look at the PE, right? And so we have a widget, a special widget for PE ratio, but we don't have the classic way of treating PE, i.e. we have a very different view of what a PE is. Most of the time you'll find P ratio like it is 41, which is the price divided by earnings. But then you have no notion of growth, right? You don't know if the company is growing or not. You have to marry this with the PEG, a PEG of 3.14. So my question is, how do I know if a company with a PEG of, a P of 41 and a PEG of 3, like Microsoft, compares to a Google that has a P of 38 and a PEG of 1.88. Okay, how do I know which one is better? Well, you can't, right? You have to say, okay, for 188, 38, you know, it's kind of difficult to figure that out. So what we did is we created our own calculation, which is the cashback PE, which is very different from those two numbers. It actually takes, so if we go back to Microsoft, it takes the potential earnings per share that you will get on year 1, 2, 3, 4, 5, all the way to year 30 and plus on your investment. So Microsoft is $300. What you would do is you would spend those $300 to buy one share. And on year 1, what we do is we look at the matrix and then we take the growth and we take that growth into account and do an interpolation between the estimated growth from Wall Street and what the growth could be on year 1 and 2. And what we get is we get a growth of 19 for year 1, 15 for year 2, and 11 for year 3, 5. The result is you get $10 per share on year 1 that you could potentially pocket, right? Because you bought one share at $300, and $11 on year 2, and year 3, 5, 41, so you get 62 here, and then the rest you get the revenue all the way so that you reimburse your $300. So in total, the cashback PE is really how many years will it take you to recoup your $300 investment, to get your money back, you get your cash back, right? So that cashback PE is very useful to put things into perspective. You have very high flyers who have P of 300, 500, 2,000, right? But in reality, if you compute that with their growth level, they're growing, you know, in a fairly, their P is fairly reasonable. And we can see it here where it's almost half, or it's more than half for Microsoft. Okay, so if we look at Google, so Microsoft has P of 18, and if we look at Google, then we have a P of 11. Why? Because the growth is 15%. And whereas Microsoft has a growth of 11%. Okay, so the next question is, how do I look at stocks, or how do I find all those stocks that are affordable and very cheap growth? You have a button here that we set up to run the screener, which is called cheap growth. And the cheap growth, what it does is run the screener automatically for you and pick the right fields. Also, you have, when you subscribe, you have that get daily notification that helps you get an email every day of the top 10 cheapest growth stocks you can find. So if I click on cheap growth, what do I get? I go to the screener and I get this. So a bunch of fields, both in financials, you get P ratio and this, and the cashback PE here on the price analytics. So the cashback PE is the first column, and what I want to know is, well, let's assume I want an affordable cashback PE, let's say below 30, right? or 31. And I want really high, abnormal, absurd PE, like the 200, the 300. And I want to know what's really their richness, right? And so you marry it with the long-term growth. And this is the column you have here, 25, 35, 25. So all these companies grow at a 25 to 35% a year. So it's pretty impressive, right? And as a result, their P ratio is really affordable. So the value is there, and it's cheap. It's growth on a cheap, right? Whereas if you look at a P of 1.53, even if you put in the PEG ratio, we can put the PEG in there, PEG ratio, you're still confused as to, all right, which one's better, 153 with a PEG of 8, I don't know, or 119, a PEG of 4, which one's better? And this here is super simple, 20, 22, 22, and so on. So, and actually you can filter, you can take the cheapest or the most expensive ones, and have a look. So it's really, really powerful. Marry this with earning momentum and sales and timing, and you know what you're getting, right? You're gonna get great stocks, affordable, and ready for you to invest. All right, so I hope that was useful, and if you have any question, let us know.